This scatter plot maps top hedge fund managers, plotting return against risk. As data points populate for elite investors like Soros, Dalio, and Buffett, a normal distribution curve emerges. Then there is the Medallion Fund. Generating 66% annual returns, it places at a statistically impossible distance within this distribution. The standard fee structure for the hedge fund industry is 2% for management and 20% of the profits. Medallion commands a 5% management fee and extracts 44% of the performance gains. Even after those fees are removed, investor returns average 39%. Over 3 decades, this consistency has produced more than $100 billion in total trading profits. These numbers contradict the efficient market hypothesis, the idea that asset prices perfectly reflect all available information. This performance suggests that Medallion operates using a logic that is entirely detached from the fundamental analysis used by traditional finance. The architect of this system is Jim Simons. Long before he entered the market, Simons was a prominent academic at MIT and Harvard, specializing in geometry and the study of multidimensional spaces. He applied that mathematical rigor at the Institute for Defense Analyses, or IDA. Working as a codebreaker during the Cold War, Simons cracked Soviet encryption systems by identifying structured patterns hidden inside random static. This career in intelligence ended in 1968, when Simons was fired from the IDA for publicly voicing his opposition to the Vietnam War. Simons eventually turned his attention to trading. His initial attempts were discretionary, relying on gut intuition and phone calls to human brokers, an approach he found both inconsistent and deeply frustrating. The breakthrough occurred when Simons discarded the economic narrative entirely. He stopped trying to predict business outcomes and realized the market could be treated as a noisy transmission channel that could be decrypted mathematically. Simons founded Monometrics, the precursor to Renaissance technologies. Its early fund was named Nimroi, an anagram for the protagonist in Joseph Conrad's Lord Jim, a character struggling with the moral consequences of abandoning his ideals for a chance at wealth. The team made a strict operational decision. They would ignore all fundamental economic data. Corporate earnings reports, news events, and supply-demand metrics were explicitly excluded from their models. To find patterns, they needed history. Well before the era of modern datasets, the team scoured the globe to locate decades of historical pricing records. They spent years manually digitizing and mathematically scrubbing archaic World Bank ledgers and pre-war currency valuations to create a clean, uniform stream of digital price ticks. Predictive algorithms are only as effective as the data they ingest. Without this precise, scrubbed input layer, any advanced model they built would have been crippled by inaccurate information. With the data secured, Simons recruited mathematician Leonard Baum to apply the Baum-Welch algorithm to the markets. This schematic represents a hidden Markov model, a tool for inferring invisible environments based on visible outputs. The top layer represents unobservable abstract states, while the bottom layer shows the observable price ticks we see in the market. The algorithm continuously updates the probability of moving from one state to another based purely on the sequence of incoming price ticks. The model successfully mapped these abstract states onto market behavior. Crucially, it did this without ever needing to explain why the market was behaving in a certain way. Mathematicians James Axe and Elwyn Berlekamp later applied stochastic differential equations to the model, refining these predictions to handle the volatile markets of the late 1980s. After years of development and testing against their historical data, the models proved viable in live markets. By 1990, the fund reached $800 million in assets by trading commodities and currencies, prompting Simons to rename it Medallion. While these early patterns generated significant returns, the approach hit a physical limit. The commodity and currency markets simply weren't large enough to support the billions of dollars Simons wanted to deploy. This was the scaling problem.
The team couldn't manage more capital without entering the much larger equity markets, but stocks were far noisier than commodities. Their existing models failed when applied to stocks, which were influenced by too many overlapping variables for the original Markov chains to isolate. To solve the noise problem, Simons hired Robert Mercer and Peter Brown, two experts in speech recognition technology from IBM. Simons maintained a strict hiring policy. He looked for physicists, linguists, and computer scientists, while explicitly banning anyone with professional Wall Street trading experience. Mercer and Brown applied speech recognition logic, designed to pull a single voice out of a noisy room directly to statistical arbitrage. They began treating stock price fluctuations as audio signals that needed to be cleaned. In 1996, computer scientist David Mapperman fixed critical bugs in the equities code, allowing the systems to finally achieve consistent profitability in the stock market. Rather than using different models for different sectors, they built a single, monolithic algorithm. Every signal, across every asset class, was processed by the same central codebase. By treating the entire stock market as one massive, noisy audio file, Renaissance enabled its system to deploy capital across thousands of individual equity positions simultaneously. However, finding a profitable signal is useless if the physical cost of the trade erases the profit margin. This is known as market impact or slippage. As this order book shows, a massive buy order at $10 can instantly deplete liquidity, forcing the system to pay a higher price and move the market against itself. Across millions of trades, these microscopic price shifts can completely consume the model's calculated edge. Simons became obsessed with tracking this friction. He demanded that the team account for the exact cost of every single transaction. The algorithms were re-engineered to hide their intent. The system learned to fragment large orders and utilize dark pools to minimize its footprint on the market price. Surviving the physics of execution allowed Medallion to scale into a high-volume system that captured millions of microscopic pricing errors every year. Quantitative edges do not last forever. Markets evolve, competitors catch up, and the mathematical patterns eventually decay. Renaissance built automated kill switches to track this decay. When a signal's performance drops below a specific threshold, the system automatically cuts the trade. This required engineering humility. When a model failed, the team destroyed and replaced it, rather than trying to justify its losses. But maintaining this discipline was difficult during moments of crisis, even for Jim Simons. During the 1998 Russian financial crisis and the dot-com crash, Simons experienced moments of panic and considered overwriting the system's models manually. The fund survived because the algorithms were allowed to adapt to the volatility without human interference. It was a lesson that the machine's logic had to be more resilient than human emotion. Medallion eventually reached a physical capacity limit where it was simply too large to keep growing. If the fund grew past $10 billion, its sheer mass would start distorting the signals it was trying to capture, effectively destroying its profitability. To prevent this, Simons capped the fund and expelled all outside investors, restricting the strategy exclusively to Renaissance employees. To maintain its record as the most profitable fund in history, Medallion had to be permanently sealed off from the public. This success eventually created cultural friction. Robert Mercer used his Medallion wealth to fund far-right political movements and the 2016 Trump campaign. In contrast, Jim Simons committed billions of dollars to the Simons Foundation, supporting basic science, autism research, and cosmology. Renaissance did launch a consumer fund, the REF, though it was designed to trade much slower and intentionally lacked the outsized returns of the employee-only Medallion Fund. The track record established by Renaissance Technologies suggests that financial markets function less like rational economies and more like complex, noisy systems, ones that will consistently yield wealth to those who build the right algorithmic filter.